I feel like the uplift is an understanding that maybe the worst is over in that we're not going up 4,000%, and instead we're going to be stable. And I think it takes the consumer a little bit to catch up, but then it's back to business as usual, just with a different price tag attached to it. Welcome back to Real Investing, where we talk about real investing for the everyday investor. Tim Harridge with my buddy
Ryan Harper, and with us we have Dalton Barnes in the house.
How y'all doing?
So, investment committee. Let's just dive right there.
Go straight into it?
Yeah, I mean, look.
I don't even know what y'all are talking about.
So, hello, Dalton. Now, look, I mean, money is hard to get right now because everyone has it and they don't know what they're supposed to charge for it. And they're afraid that if interest rates go up, they gave it to you too cheap. Or if interest rates go down, maybe they should have waited and bought themselves, right? Like, I mean, capital is available but tricky.
Ask Silicon Valley Bank about missing that missing that boat.
Hey, look, a mark to market on a book, if interest rates go up, could be crushing.
Yeah.
When you say money is hard, do you mean for single family? Do you mean for commercial real estate? Do you mean for real estate? Or do you mean for everybody?
Yes.
Look, I think it's been more difficult for commercial recently. I think commercial's about to get a lot better, specifically with the new executive action that Trump signed ordering government employees back to work. I think the big Fortune 500 companies are right on the heels of that. And in general, what needed to be rebalanced has already been rebalanced. And so I told my office, I said, hey, y'all, look, President just said we got to go back to work. So April 1, no more hybrid unless you're remote and you're not near one of the, like, so if I did hire you and there's no office, I'm not getting a damn office for you to go to work at, right? You can keep working from home. But if you're one of those that lives 10 minutes from the office and only coming in 2 days a week, guess what? You're coming in the office. I'm going to copy the president.
Not losing too much time on commuting for those people.
Right. So I think that'll help the commercial market. I think multifamily debt is going to be very difficult to get for the next 2 years. Multifamily rents are down year over year. They're way down over the last 2 years. And there's a lot of value add deals that were contingent on 15 to 20% rent growth. And it's and I'm in some of these syndications. We're talking about 1,500 units in Dallas-Fort Worth. Mm-hmm. Right? It's 5 different apartment buildings.
Are you seeing that on the SFR side as well?
A little. So I'll finish multifamily.
Yeah.
So I've got one syndication I invested in. It's 5 buildings. They're all about 300 unit buildings, and we are way behind on rents and still below 80%. No, below in the 80% occupancy area. The CapEx has all been spent, which would tell you that the income and everything should be up because it means we've already done all the repairs we were supposed to do, adding swimming pools and fences and all that stupid crap. And it's just evictions after evictions, low occupancy, and the rents and a lots of. If you want to gauge the health of a multifamily market, drive around and look for rent specials, right? And if you look around Dallas right now, 2 months free rent, third month free, every other month free. You know, it's like because they just need you to sign the higher contract of the higher rent amount so that 6 months from now, their T12, their trailing 12-month statement shows that they have a high rent roll.
So you don't. See, I think as a layman, I would see that and be like, oh, they have a high vacancy and they're just trying to lure people in. So what you're saying is not about luring people in, it's luring people at the correct rate.
It's both. Right? Instead of just saying, oh, we'll take $2,000 a month, right? Instead of $2,500.
Yeah.
Right? So $500 a month over 12 months is $6,000.
Because you also got to think at the end of that lease term, it's going to go up proportionate to the base rent.
Right.
Have a higher base rent, that proportional increase is going to be higher.
So when you're getting it for free, you're not getting it for free.
Oh, you're paying. Think about it. They give you 2 months free at $2,500. That's $5,000. If they rent it to you for $2,000 a month, that's $6,000. So you actually come out better financially if you take the lower rent amount. They come out better if they give you 2 months free.
So the lesson here is, kids, is if you get like, hey, 2 months special, be like, no, I want to pay.
Well, it probably shows you a place that either A, is going to have probably low staffing and amenities aren't going to be super great, or B, that rents may be cheaper 6 months from now than they are today. It's definitely not a good thing. The old wait list on apartments from 3 or 4 years ago, that was a good thing. So then there's single family. And you're a commercial debt guy, right?
Sales. Yeah.
So a lot of the debt service coverage ratio, long-term rental loans in the single-family space go into these hybrid securitizations that are partially commercial mortgage-backed security and partially residential mortgage-backed security. And it's been interesting, the delinquency rates since we started doing this. We did the first securitization at B2R Finance, actually 10 years ago this April. Actually, I'm flying up to New York to celebrate the 10-year anniversary of that deal. Delinquency rates since that first one have been around 2 or 3%. In the last year, we've seen that go up to 5%.
Oh, wow.
Yeah. Because what's happening is even if an investor has a 3.5% interest rate and their house has gone up 30% in value, their insurance has gone up 50%, their taxes have gone up with that, because they don't get the homestead exemptions, right? So the county's like, yeah, congratulations. And in a state like Texas, when your house goes up $100,000, that's $3,000 a year, right? Said another way, that's $400 a month, or no, not 400, $250 a month,
yep.
Right? Well, yeah, you got a $150 rent increase every year, but your property taxes went up $500 a month, and you're upside down.
I think I saw Governor Abbott say something about either a 2 or 20 billion reduction in property taxes, and that might have just been a talking point. I don't know if there's actually pushed through, but I know they at least acknowledge that it's a problem.
Most of it's to owner-occupied housing. Most of the property tax reform and property tax relief does not apply to real estate investors.
Of course not.
There is actually, I want to say it was a 3-year pilot where it was limiting increases on investment properties. It was either 20 or 50%. So it's not the homestead 10%, but at least there was a limit, because I had some properties that doubled in value in a 2-year period. So said another way, if it goes from 3 to 600,000, right, your taxes go from about $7,000 to $14,000. I mean, and
that'll crush your net income.
Yeah, I mean, so we've got some houses right now that we've sold because they were negative cash flow, and we felt like the appreciation was kind of topping out. We've got some other properties that we've like in McKinney or Frisco that are in the path of growth of where like these. Well, you see, there's like now McKinney's going to become a commercial airport.
Yeah, I saw that.
And they're building the big music venue and the water parks and the
hold that for another couple of years.
Yeah, right. So I feel like those. So I'm okay losing.
You looking for investors on those?
No. I'm okay losing a couple $100,000 there, a couple $100 a month, not a couple $100,000.
I was gonna say, I was like,
a couple $100 a month on that is like an like a savings account for me.
Yeah.
But there's other markets like some of these Garland, Mesquite, inner city Dallas that we're taking really long, hard looks at the net operating income and cutting the losers and then reinvesting the capital when we can find something to buy, which we can't.
Especially to your point earlier about the lack of rent growth in the core urban areas, your upside is basically diminished, and with those increasing costs, you're only looking at further negative ROI at that point.
Yeah, I mean, so that's the thing. Multifamily rents have gone down, but single-family rents are flat. And some people are like, well, Dallas is growing. Dallas is growing, but rents are flat or down. There are some subsets that rent the cost of rent is down over the last 2 years.
I think they mean the Metroplex is growing.
Oh, yeah. I mean, and that's where I think investors have to be really careful with looking at medians and averages and trends, right? Because the overall average of Dallas-Fort Worth may be going up, but that's like everything from West Fort Worth to Rockwall to Plano to Waxahachie.
Yeah.
So if you're not from Dallas, that's like 400 square miles. It's the size of like twice of Rhode Island.
One thing I heard this morning.
So it's
I was in a real estate event this morning, and I don't know if it's quite relevant to this conversation, but I never heard it. I never heard this before, and it was the fact that, like, if you really look at Dallas Fort Worth right now, Central Dallas is no longer Dallas. Central Dallas is now North Dallas, because of the growth to Frisco, to Prosper. And I was like, and that might have just been saying that because it was a North Dallas Chamber event and they're trying to make them feel good. But it makes sense because, like, you have all this explosive growth north of the railroad tracks, but, like, South Dallas does grow, but it's not nearly as much as, like, North Dallas. And I guess my overall point was just the mindset that as it expands, North Dallas is kind of like that new hub. But
and I think it, again, there was an article in the Dallas Morning News this weekend about the lack of grocery stores near Redbird Mall in South Dallas. And there was a Tom Thumb that I think was awarded almost $6 million in incentives that spent a year planning and even bought the land and then backed out of their plans to build there. I think when you're selecting a market for any asset, you have to really look at the growth drivers, right? Are values going up? And if so, why? Are rents going up? And if so, why? And
Right.
I mean, I think, cost of living, I think quality of life, I think in residential, schools, in commercial, transportation is a huge thing. Like, people don't understand, like, the cost of transportation these days. The IRS just revised the guidelines for like self-employed people in the mileage, and now it's over 70 cents a mile. I mean, that's how expensive it is to operate a vehicle. So if you think about it, if you're telling someone to commute 30 miles a day, I mean, per, like, the real math, it probably costs those people, if it's 30 miles each way, $50 a day.
I mean, what's
to go to
that?
work.
What's that? 30 miles? Are we talking the tollway? Or are we talking 75?
Yeah, right. Well, I mean,
Are you talking to 30?
well, I'm just talking about miles in
But,
general.
yeah.
I mean,
Yeah, 'cause
the
they
wear
can
and
now
tear
have
on the
drive,
vehicle, the tires, the gas, and the cost of automobiles. Right?
Yeah.
So you were talking about you have a new child coming, right?
Came last week.
Yeah. I mean, so my congratulations.
Yeah, we're in it.
I mean,
We're deep in it right now.
I have a 15-year-old that is now, he turns 16 in October, which means I've got to buy him a vehicle. And
I'm gonna give you my phone number. Just let me know when they're on the road so I can stay home.
I'm not sure he's going to get on the road at this point, but my wife and I we were in New York last weekend meeting with some hedge funds, and we were talking at dinner. I was like, "Hey, look, I'm thinking about giving him my truck," and she's like, "Are you out of your mind?" And I drive a really nice truck. I mean, and I was like, "Yeah." I said, "The depreciation hadn't run out yet. He can do some stuff for the business, and I may just get a daily driver. Like, I've always kind of wanted a Jaguar for some reason. Don't hate me on that, but
like pre-new logo Jaguar.
I haven't looked. Anyway, the point
Sorry
is,
about that ad campaign.
He doesn't know anything. You may want to rethink the Jaguar.
all right. Well, anyway, look. The point is,
Yeah.
I may buy something that's not a truck.
Yeah.
Oh, I thought about
Tesla?
the Broncos.
Oh yeah.
Those new Ford Broncos. They're over 7,000 pounds.
Oh yeah.
Certain models of them are. So anyway, the whole point is, with the cost of everything, commute and location and transportation affects commercial values. Cost of living and quality of life affects residential values. And then obviously multifamily is affected by kind of a combination of both. I'd
Yeah.
say.
Okay.
Well, earlier we were talking about interest rates, and we're talking about all that, and like the disparity between bid and ask. It's like, if interest rates are high and prices are also high, like at some point one of those has got to give, right?
No.
So we just stay high interest, and then it just demand decreases.
keeps your velocity low. A lot of capital sitting on the sidelines waiting for deals to pencil, or you got to get real creative on adding value for deals to pencil.
Or you have the third year in a row of the least transactions ever per capita, and eventually the demand boils over. Every year there's more people. Every year people make more money. Every year people live longer, which means every year there's going to be even more people. Eventually, they'll save enough money that they can afford to buy that house, right? Eventually, there'll be enough companies that have enough employees to buy that building or rent that building. It's what happens in a time like this is they stop building. And that's what you're starting to see. In certain markets, building is off the charts. In other markets, it's grinding to a halt because demand is drawing back. But more people, they get married, they hit this age thing. I think, we're going to see about the baby boomers. I mean, they're saying there'll be a lot of inventory that
The
comes
silver
into the
tsunami.
market. Yeah. But I'm actually thinking a lot of the kids whose parents die are going to be like, hey, a house. I mean, they already live there anyway.
Yeah, so you're talking a lot of transactions of need where, you need a place to live, you
Right.
need a place to work. I mean, my background is a lot of 1031 exchanges, so just passive investors looking for one asset to another. So I agree with you on the commercial. Or, I mean, people selling a portfolio of residential houses and looking to get into something triple net, a little more passive. And right now, to kind of what you're talking about, the bid-ask spread, if you're sitting on a 4% interest rate with a 10-year note that you bought at a 6.5 cap, and you're looking that you bought 3 years ago at a 6.5 cap, and you're looking at 6 caps today with 7% interest rates, you're like, why would I sell this? I'm just going to hold this for the next 3-4 years. So eventually, as those notes kind of come up, you'll get those transactions of needs. But I think on the at least the net lease commercial side, there's not as many. These people aren't buying their buildings to operate out of them or live in them. So they're kind of just like, I have a good coupon right now. Why would I get rid of that?
My best syndications that I've invested in are triple net leases. Absolute best, because they are performing really well.
I hope you don't have any Walgreens in there.
Huh?
I hope you don't have any Walgreens in there.
Can you? I don't know why that's funny.
They're closing a bunch of stores.
Really?
A lot. When I got into this industry, Walgreens was the golden goose. If you bought a triple net Walgreens, that's as good as a U.S. Treasury. Cap rates for them was like some of the lowest. Now I'm seeing them trade in the 8% cap rates just because they've been shutting like 10% or so down of their stores for the past few years, and it's just, there's not really an end to that trend in sight.
And if you go back to when all the old Eckerd's drugstores went out of business, are you old enough to remember that?
I wasn't until you said it, and then I had a flashback of like, I know that for some
It was
reason.
blue logo and all that.
Yeah.
Well, there was about a 10-year period of there where, about every 10 or 15 blocks you drive through a suburb, there'd be a vacant Eckerd's building just sitting there. And that's kind of what these Walgreens and CVS.
Well, what's crazy is Walgreens will have a 15-year lease paying $250,000 a year, and they'll vacate it. They'll just let it sit empty. I don't know their full strategy behind it, but I know some brokers who specialize in the drugstore space, and they have lists of hundreds of locations where they've got 10, 11 years of term, and you basically sell it at that point. It's just the value of that annuity plus dirt.
Because it's a corporate tenant.
Yeah.
You're going to get paid.
You're going to get paid.
I've never
Unless they
understood
go
that
BK.
though, because there's an old Albertsons in Uptown. Hadn't been to Albertsons in like at least 5, maybe even 10 years. I don't even know the perception. It's been a while since it's closed, but I guess because it's so damn expensive to be there, there hasn't been a new tenant. And I just don't understand why this prime real estate is sitting empty in the heart of
It's usually
Uptown.
the other operating costs or the other costs of occupancy. So, I mean, if you have your doors open, you got to pay insurance.
Mm-hmm.
What are your utilities? What is the cost of employment? It's those other things where you look at that versus if you close the doors, you pay your basic property insurance and rent. That's the calculus.
So it's going to be a loss, or it's either a small loss and do nothing, or potentially bigger loss and then have a lot more headache.
Yeah.
Well, I'll put it like this. I mean, so if you think about some of the short-term rental properties that residential investors have, the one that Jennifer and I have, we do a lot of temporary midterm housing in it. But if we were to turn off the utilities, and that's, by the way, that's electric, water, sewer, TV, yard service. Probably still have to pay that, but maybe not water the grass. Our base operating cost for a vacant structure on that home is about $1,100. It's about $2,500 if we have it in service. So mathematically, that's small, relatable residential numbers, and just 10 or 15x that over there, and that's the decision.
The other issue for Walgreens, and Family Dollar is recently going through this too, post merger. With Walgreens, they were actually ordered to shut down some stores to prevent when they purchased Rite Aid. Part of that was anti competition. They had to shut some stores, but then also it's not uncommon to stand on one corner, see a Walgreens, and see a Rite Aid right there. So if you're within a block, you can't have two stores in that market. So it's cheaper at that point to just shut it down. Make it a Spirit Halloween store periodically.
Right. Well, I'm very familiar with the idea of sunk cost. So
Yeah.
that's what it is.
Yeah.
Well, the whole bid-ask thing, right? It also comes from, in residential, a lot of people normally think in terms of ARV, right?
Right.
And
that one I can talk about.
yeah. Well, if you really think about it, it's a yield. You've got X dollars invested in it, and you make Y in net income, right? And you've got a yield. And so if you were to sell that and take your equity, now your yield on that equity changes. Your return on your equity changes. Now, right now, with rates doing what they're doing, it's pretty easy to get a money market to give you 5%, which is better than a 4 cap. But you recoup some depreciation expenses. So typically they want to go place it into another project. Well, the problem is right now is if they can't sell this on a 6, or if they can't sell this on a 4 and they have to sell it on a 6, they're just going to go buy another 6. Why the transaction cost? Unless you really just have to buy a bigger asset. Or now I think some of that will help when we get 100% bonus depreciation back, which surely is coming soon.
Knock on wood.
Oh, it's that's going to be.
That's got to come back.
Well, Daddy Trump is a real estate guy.
So Daddy Trump's a real estate guy that needs inflation to continue going up.
That was the other thing I was going to say is it should help us out after this year is they got to redo the tax code.
Yeah.
It expires this year, so that they and I'm betting that 100% depreciation is going to come back.
Yeah, and that's a silver bullet that they'll save for comprehensive reform. And I would imagine they'll try to codify that into permanent tax code. Specifically, since if Trump believes that his children will continue the enterprise, there's nothing better for a commercial developer than the bonus depreciation rules.
Yeah. It incentivizes transactions, which is overall good for the economy.
I agree. Especially since I haven't paid taxes in 5 years.
Legally.
No, yeah, I file taxes. I just don't have to pay.
Yeah.
That's the complicated thing on the finance side right now is people want money, but their returns are low and the inventory is limited and comps are limited. And so we're always trying to make common sense lending decisions. And since we loan our own money, I'm not driven by some Wall Street hedge fund or some big, thick underwriting guideline book. It's Tim Harridge.
Right.
And his experience buying houses, trying to be consistent. So
earlier we were talking about velocity of a deal flow and velocity of everything. And you know how in the employee world, the workforce, the labor world, you get to a point where the unemployment, the numbers kind of are not accurate because then you have people that are just not working at all and not even trying. Do you think with the high rates and the high interest, when it comes to deal flow, whether it be single family or commercial, people just hey, I'm not even going to try because I know I'm not going to get the thing. So then you have just a lot of deals sitting on the sidelines because they're waiting. I don't know if there's a question. I'm just trying to go for topic.
There's a question.
No, I think I have a lot of conversations with investors. There's a very prominent development group here in Dallas. And they've been doing commercial net lease development for a couple decades. And about 2-3 years ago, they just started a fund and just started. They would normally merchant develop, sell as soon as the project was over, get a good cap, move on to the next one. But they were sitting on capital. They're like, well, we could just buy it in this fund at the cap rate we're developing it to. We're not sure where the cap rate is on the exit, so we'd rather just get that yield ourselves. And I've talked to a few different people that have funds that are just waiting on the sideline to figure out, okay, what's the tax code going to be? What's the transactions going to be? If I'm going to get into something that's a shorter and medium term, how do I comp out that exit right now? Because the lack of comps is so detrimental to the whole underwriting process.
I mean, as I sit here today, Jennifer and I have never had as much liquid investment cash or equities as we do right now. And even, I mean, our money in the stock market, I mean, we're making 20% a year the way this thing's going. I mean, like, and we're not even levered, but we've got a line of credit against it. If we need money, we can go get it, and it's like 6.5% and half, like a $500 transaction fee for 60% of that, and it's in my account the next day. And it's crazy because every couple months the market will drop 3 or 4% in a day, it seems like, and then it's up 10% the next month.
Yeah.
And I mean, I think
that's the other thing is
I think we're up almost 100% in the last 3 years.
Something like that.
Yeah.
That's the other thing is normally, or it used to be in real estate, you could seek higher yields through flipping, through creative investments. But with the way the stock market's performing right now, why would I tie it up for 2 years when I can get similar yield with much higher liquidity?
Well, and the big institutions are, I mean, they're getting leverage on their equities portfolio. So, I mean, they're making 40% in the equity market just by buying and holding.
Yeah.
That's not even trading. And like, even us, I mean, we've never had this much cash just sitting in the bank unused, but I mean, Texas Capital Bank's paying me 5% on a money market right now. I cannot buy a new rental property right now and make a true 5% return on equity unless I go buy a really cheap house that needs a ton of work, and that's a lot of work.
I think my saving account has a 0.0000001% interest.
You need a different savings account.
Well, I'm aware.
Okay.
Yeah.
Let me know if you need an introduction to Texas Capital Bank.
Yeah.
Because even Chase is paying 4 or 5% right now. I think it's 4.25% in the money we have there, and it's just, I don't know. It's just it is hard to justify the market risk of a transaction in an unstable environment. I mean, let's just be real. The barrage of bullshit that's coming out of Washington, D.C. right now. I mean, what, we're going to do a fucking condo development in Gaza Strip now? Like, that was the news yesterday and the day before.
Talk about creative ways to seek yield.
Yeah, I mean, the day before we're changing the citizenship laws in the country, and then the day before, I mean, it's just, with all the turmoil and uncertainty, and the diehard Republicans, my friends, are like, hey, it feels so much better now. You just feel like everybody's taking a deep breath, and I'm just like, I don't know what you're looking at, man, but like, that's not what I'm seeing. And if you look at the bond markets and the treasury markets, that's not what they're seeing. So I think it's going to be a tumultuous year. I think inflation is going to be sky high. We may even see Federal Reserve rate increases in the next 3 to 4 months. And
based on what the bonds are doing, yeah.
And
which sucks for us.
What is it? The freaking Waffle House is doing a 50-cent per egg surcharge right now.
Yeah.
I mean, this is it. Trade wars create inflation. Trump came out and said it may be painful for a little while. So if you thought last year was bad, just Control C, Control V, copy and paste. Same thing this year.
I was at a lecture last week with Robert Kaplan. It was a World Affairs Council event. And
I gotta start coming to these things you're going to,
dude. Yeah, everyone should.
Yeah,
this man gets the insider information about when all the
cool shit is. Well, I didn't get that through SMU. I got that through a buddy of mine who I need to actually introduce to, General Jim Williams, 2-star.
I want to meet him.
2-star in the Marine Corps. Yeah, he's badass. But he was, because I do the Goldman Sachs. He's like, "Oh, you should go to this event. My buddy is at there. It's Robert Kaplan." I'm like, "Yes, sir. I'll go." And but anyway, in that event, it was Wednesday of last week, or by the time well, actually, this might come out sooner, but like 2 days before was the government shutdown, and he was just like, "Listen, everybody, if you think this is all a ploy, basically buckle up because Trump does mean business. So there will be some relearning of what's going on." But it was a fascinating talk. But anyway, my point to bring that up now is just, yes, there is turmoil, there is uncertainty, but it's by design.
So it is by design. Steve Bannon, he called it muzzle velocity, right? So if you overwhelm the media,
Flood the zone.
yeah, flood the zone. They can only talk about the things that they find the most insane.
They can only print one thing at a time.
Yeah.
I think
So if you talk about four, you're ahead of them.
Yeah.
I think all of this is just for book deals, because every time I see a news thing, it's like, well, this is the classic art of the deal. I would love to. I bet you anything that book will go to New York Times #1 in the next month or so.
I'll tell you this: if someone hasn't watched, there was a movie last year. I think Trump sued him, called The Apprentice, and it was kind of how he and Roy Cohn got into deal making in Manhattan when Trump first was kind of getting away from his father's tutelage. And
Didn't the guy who played Trump go up? Wasn't he nominated for an Oscar for that?
Yeah.
Yeah.
It is fantastic. It's a great movie. But, I mean, if it's anywhere near accurate, like, it will help you understand what's going on right now. Mm-hmm. And all I'm saying is you should believe nothing you hear. Nothing is serious. It's all showmanship, and it's all meant to be a deluge of distraction.
Right.
But going back to our point earlier about certainty of yield, it's impossible to underwrite when you're not sure what the bond or what the yield is going to be on, or what my interest rate is going to be when I actually lock in that deal, or on my exit, which is going to affect me just as much. Because if I'm buying this expecting to get, to add 50% value, but interest rates go up 25, 30%, well, shit, there goes my yield on my exit. Why would I tie that money up for 6 months to a year?
I said this a couple months ago. Everyone has to understand, everyone's money comes from somewhere. Everyone. The loan money comes from the bond market, which is driven by the treasury market, which is driven by the stock market, which is driven by individual investors, which is driven by payrolls, which is driven by, it's a big circle of an ecosystem. And you cannot pull on one string. It's impossible. Every string is connected. And so when you increase payrolls, you increase 401k contributions, which means you increase mutual funds, which means you increase the equity market, which means you increase corporate bond debt, which means it all goes. And when you decrease compensation or payrolls or have job losses, you are pulling money out of the system. Mm-hmm. It's just so simple now that I've tried to study it, and I'm nowhere near a master, but chaos is the most destructive thing for
the business community.
Because you don't know where your money's coming from.
You want stability, so when you're underwriting a project, you can underwrite, okay, here's what my growth rate is going to be. Here's where the market should be a year, 2 years, 3 years from now.
This conversation is making it more evident why people get into single-family real estate.
Yeah.
Because I buy the house for X, I put a little secret sauce on it, and I can either lease it out or I sell it for Y. And it's the difference is, or whatever, that's the profit.
It's a lot less influenced by macro factors.
And then all that other magic mumbo jumbo, like, oh my God, big words. Like, this guy went to Harvard or something.
If you know your market, if you know your neighborhood, you can
turn off reality to the outside world and just focus on your neighborhood.
Yeah. Our last guest, Jason McDougal, he's like, I bought some tax lien property for $50 and sold it to the neighbor for $140. That ain't
within a week.
It doesn't have a damn thing to do with anything we've been talking about for the last 30 minutes.
Right.
It yields don't matter, bonds don't matter. What we're doing in the Gaza Strip or not doing in the Gaza Strip doesn't matter.
Even the word yield, I don't think in the first 10 years of being in the real estate community, I don't think I've ever heard the word yield.
Yeah,
it just doesn't come up.
Me neither.
Until you talk about lenders and interest rates.
Well, and I think that's the most important thing is when you do hear something like that come up, you have to stop and be willing to say, "Wait a second, Mister You, what is that? What do you mean?"
Yield means something different to different people too.
Everyone,
if I'm a buy and hold forever, I don't really care what my exit value is. I'm looking for cash flow.
Right.
If I'm a flipper, I don't really care about the cash flow as much. I'm looking to add my secret sauce and seek yield on the back end of that property.
Mm-hmm.
Well, think about it. So I do hard money notes, and I charge 12% interest. I sell those notes to people. They get the 12% interest. What do you think the yield is on that? You would naturally think 12%.
Well, I would think 12%, but at the same time, it's like, well, what did you get the money at? And I was like, well, I don't know what the delta is there.
How's that 12% structured?
Yeah. Well, I mean, I'm selling it as a whole note, but they may be putting 20% down and warehousing 80% at a bank, and that 20% may cost them 8%, and this may cost them 6%. Like, there's, to your comment, never assume that the yield or the ARV or the cash on cash return or the ROI or whatever someone tells you they're chasing, never assume you know their formula. Stop and say, cool, man, how do you arrive at that?
Or how do you define that?
Yeah, I mean, well, how do you arrive at it? Like, tell me your math.
Right.
Like, I want to know so that I don't waste your time. I don't bring you deals that aren't going to get past your underwriting. How do you arrive at that? I use an in-place cap rate. Okay, but do you use T12 actuals or are you adding a pro forma
What are
on
your
top
assumptions?
of it? Yeah.
What's the model you're using?
Yeah. If I'm at a 4% vacancy, are you going to automatically increase me to 6% and stress test me?
Yeah. As a broker, these are the exact kind of questions I ask just to make sure I'm speaking the same language as my client. Because to your point, if I'm bringing you a possible deal to buy and I say, hey, you say you're looking for a 6% yield, this is probably 6.5% yield, but I'm missing an assumption, or you've got some other funky formula, and you're like, this is a 3% yield, and I'm speaking Spanish while you're speaking Portuguese, and we're 2 trains passing in the night.
I just want to point out that
I don't speak either.
I've completely understood this entire conversation.
Really?
From day one, yeah.
Are you only focused in the Dallas area, or are you kind of representing people across the nation?
So I have worked nationwide. In the triple net space, it functions more like bonds than traditional property. So I mean, I've literally underwritten property in all 50. I've invested in 6 different states. I've never done deals in my own hometown. When I was living in LA, I was mostly doing deals in Texas. When I lived in Texas, I was doing deals in the Northeast. It's just kind of where I could find interesting deals.
What's the coolest? Like, let's talk about triple net a minute, because like Dollar Generals in the Midwest are a super solid investment. What are some cool things that, and people don't understand, like, if I tell you I'm a commercial landlord, you may think that I spent millions of dollars. I mean, some of these things you can buy for a couple $100,000.
Cheapest property I ever sold was $425.
425?
Uh-huh.
Yeah, and what was it?
It was a Jiffy Lube in some small town in Louisiana.
Yeah. So it's like, some of these things are like, it's like a house, but it operates completely different.
Mm-hmm.
And if you're an investor out there, honestly, with good bankable financing, and you're having trouble finding inventory, it may be a good time while the more sophisticated funds and institutions are sitting there having this confusing conversation that I now understand, but I did not 10 years ago, the yield of this and that and bond of this and that and da-da-da. And you're thinking, I got $100,000. My bank requires 20% down on commercial. They'll fix me for 10 years. I can make 20% on my money on that. It may be a good time to look at triple net and things like that.
You just used a word that's come up in my life several times the last month and a half, and it's that word sophisticated.
Oh.
And what I mean by that is like the need, and this is one of those things that when you live in the bubble of single family real estate investing, you don't think about this. And it's the need to be a sophisticated owner. It's the need to have sophisticated financials. And it's like, well, what does that mean? How do you define that? It's like, well, do you have P&Ls? Do you have income statements? Do you have cash flow statements? Do you have bankable financials? That way you can go to a bank and be like, hey, give me money.
I would give you some adjectives for triple net landlords, and sophistication isn't always at the top.
Well, exactly. But the thing is, though, it's like if you're just doing a single family real estate thing, and hey, Tim, I need money, and Tim's like, 123 Main Street, and you're buying it for what? Yeah, that makes sense.
Yeah.
But if you're like trying to build a business, you're like, hey, Tim, give me some money. He's gonna be like, give me all your financials. He's gonna be like,
what's your EBITDA? What's your recurring?
Yeah.
What are your costs?
And if
you're
not sophisticated, you're gonna be Ebba who?
Yeah.
I don't know what that is.
I remember the first interview I did for Blackstone. It was a financial guy or intern, I can't even remember, and he was in the room talking about EBITDA, and like really like fancy educated people, they say EBITDA, like they turn EBITDA into EBITDA so that it sounds, I don't know, fancy.
It's not finance, it's finance.
Yes. And I'm sitting in the
EBITDA
room
with a vocal fry.
Yeah.
So earnings before interest, taxes, and amortization, if you're looking it up at home, which is what I had to do as I'm the managing director. And this
I think you
kid,
missed depreciation as well.
oh, that's not say it? No, whatever. Keep looking it up.
The big one
Thank
for us
you,
real estate
SMU.
guys.
I learned it at SMU.
I are not a speller. But anyway, this kid that I'm supposed to be interviewing, and I'm the managing director, he's talking about words that I'm just over here like, need to look up EBITDA. What else did he say?
Since you
Notepad?
opened the door on this, I'll close it for you. Because I used to work with Tim when he was on these, like, in the early stages of B2R Blackstone. And he's running the meetings. And he's the main guy on the, I don't know if it was Zoom back then, but it might have been Zoom. Skype.
Yeah.
And he's like, he's got a standing desk, like, I'm Tim fucking Harris.
I had a shirt that said that.
But off camera,
Can we cuss?
off camera,
I've been
he
editing
had
myself.
a single family real estate rentals for dummies book on your desk.
That's awesome.
And he's running this damn meeting. And he's getting paid. I don't want to say what you're getting paid, but it's a lot.
Fake it till you make it, baby.
Well, he wasn't faking it, but it was just the language of
We had never had to say those words in order to buy 1,000 houses. Like literally,
Right.
like
That's the point I'm
that's
trying to
the
make.
thing.
You're not
Yeah.
sophisticated, but you do a shit ton of deals.
John Beecham, smartest guy I ever met. He's like, the DSCR. I was like,
Innovation
no.
Homes?
No, Deutsche Bank.
Oh,
Yeah.
which
you're
one?
talking about the Goulds?
Gould, yeah.
No, so like I'm in Manhattan. We're starting this like commercial lending company for residential landlords, and this guy's across, and he's done billions and billions in finance. He's like, the DSCR. I was like, what are you talking about? He's like, and I bought over 1,000 houses. Been investing for 10, 15 years. I don't even remember. He's like, the DSCR. I was like, man, like you can keep saying it in different tones, but I still don't know what it is. And like we didn't really have Google on our phones and stuff then, right? Like I didn't even have an Uber account yet.
You need that like the new iPhone AI. What's he saying?
Yeah, like please translate Wall Street to Main Street. But yeah, it's like, and now people throw it around like crazy. Oh, DSCR loan. Oh, DSCR loan. Like that's just how fast things go. But I wanted to go back to what we were talking about because it's amazing how simple it is to get lost in terminology and to get intimidated by the terminology. But when someone says, "Oh, a triple net lease," like it sounds almost intimidating.
Do you want me to break it down?
What is a triple net lease?
Okay, so triple net, there's 3 main nets in a retail lease. Taxes, common area maintenance, and insurance. Those are your 3, like, you're going to pay those costs annually. A triple net lease just means that the tenant is taking care of those annual costs. So in theory, as a landlord, it's a very landlord-friendly lease. It's going to act more like a bond. So if you have Walgreens, for example, they were AAA back. I don't know if they got downgraded. Very good credit rating. You're gonna get those rent payments. There's a really great story. One of a buddy of mine's clients a couple years back owned a Walgreens property, saw on the news that a car drove through the property. I was like, oh shit, that's my store. Called his real estate real estate manager. Was like, hey, is everything okay? They're like, yeah, we already got it fixed. Insurance took care of it. You're good. Your check's in the mail. They call it mailbox money, armchair money, because as a landlord, you're not worrying about termites, toilets, tenants, any of that stuff. So you got a 10, 15, 20, 25-year lease with no issues from a landlord side. Now, got a caveat, that doesn't mean it's passive. Real estate's almost never passive. And that's where a lot of people go totally wrong. So talking to Walgreens, a lot of people just think I got Walgreens. It's like a bond. I'm going to sit on it forever. I'm going to pass it on to my kids. They're not paying attention to how Walgreens is doing corporately. They're not looking at the news headlines of what Walgreens are doing. Now, their Walgreens went vacant. They're still getting their rent checks, but they might not even know. I've seen instances where people, like a broker, will call a landlord, say, hey, I'm on Google Earth right now. Your Walgreens in BFE, Nebraska has boards on the windows. It's vacant. Did you know that? Well, they're paying the rent. Yeah, they're paying the rent, but the problem is now your resale value went from 6-7 cap to whatever the present value of those cash flows is plus the value of the land. So you went from a $4 to $5 million property to $1.5 to $2 million property max.
But what's the downside of that? Other than the obvious, because if you're not looking to sell, I mean, that just sounds like cool. I have lower taxes, right?
No. Well, Walgreens is going to pay the taxes. Again, it's triple net, so Walgreens is taking care of those taxes. It's not a big deal. But let's say, for example, so I said taxes, common area maintenance, insurance. I didn't say roof. I didn't say structure. So, or a lot of times HVAC. A lot of times the tenant will take care of the maintenance, but not their placement.
But if it's vacant, then you have a property that's going vacant, and then it kind of
they're not
goes,
maintaining it as much.
It can
that
get stolen,
roof,
which would be
that's the
insurance.
obvious.
No.
Yeah.
Or vandalized. I mean, there's all sorts of things. The whole point is, and with real estate, if no one's watching out for it, we see it in single family.
Yeah.
It goes to shit.
Yep.
And that's the whole.
And then when you go to eventually retenant it, you got to pay your leasing broker. You're gonna pay TIs, tenant improvement costs. You got to pay to make that space workable. You're probably gonna have to give whatever. I just released one of my buildings up in New York. Luckily, I was able to get a pretty competitive process going, and we ended up no TIs, no, basically a very landlord friendly package was what we negotiated. But we had one tenant in there asking for $1 million, asking for us to invest $1 million in space. They asked for 12 months free rent to get up and going. And all of that, and we had to take care of the taxes and insurance during that time. So at the end of that lease, you have a lot of headache. If your tenant doesn't renew, if I'm in California and I'm invested in New York and that tenant doesn't renew and I don't have a New York leasing broker on speed dial, I now have to do a whole lot of work. There's your downside. So it's not passive. If you don't stay on top of it, it will come and bite you in the butt.
But if you're sitting on a couple $100,000 and you're thinking maybe not single family, if you get the right broker or find the right person
Say
to
that
invest
again.
with, I know, right?
Not all brokers are creative equal. Do not ask a realtor to help you find commercial.
Yeah, I mean, I've got a couple brokers that I work with that they invest in deals with me. So like, okay, you're telling me it's a good deal, and you're putting a couple hundred G's into this.
Must really believe in it.
Yeah, we're in alignment now,
Yep.
right? I mean, the guy that just helped me negotiate my Charlotte sublease, I mean, absolute killer. Same guy though, right? Like, I mean, he's got warehouses in Dallas that as an agent, someone came to him wanting to sell it because they needed money, but they wanted to stay, and he would literally buy it from them and release it from them.
Sale lease back.
Yeah. And like,
phenomenal way to that's a great way to find yield right now. I'm seeing a lot of sale leaseback deals.
yeah. So the whole point is, if single family investors should not, we talked about this with Jason, should not, if you can't find new deals or new transactions, it may be a good time, I feel, to reach out and get involved in some triple net deals, either as an LP investor, or if you have the cash and you're bankable, and you can find the right deal. Like he said, they're taking care of the routine expenses. You're on the hook for capital expenditures, major, repairs, but it's a great tax deduction, and it's very,
especially if you're buying a car wash.
That's what I want to. Thank you. That's the best investment there is right now. Like, I think hands down. A buddy of mine bought one for like $1.2 million in Iowa.
It's so funny because they were not financeable about 10 years ago.
Right.
And then all of a sudden PE got involved. Mr. Car Wash went public, hit like a 30 to 35% multiple because they realized it was recurring revenue. And all of a sudden the whole world is like, oh, the membership model. These are great.
Yeah.
The rents on a lot of them don't make any sense. But
What do you mean by that?
so on a pure real estate perspective, you'll find them. I actually underwrote a portfolio of these car washes in Las Vegas. I got my hands on the financials. I was talking to the owner. Las Vegas. So two things will determine the performance of a car wash: rain and rain on the forecast. Because if it's forecasted to rain this week, you're not going to get your car washed. And your average precipitation was going to depend. So Las Vegas, phenomenal market for car washes. He was saying he wanted to set his rents around $700,000 a year for an acre and a half of land with a car wash on it. Now the equipment itself is expensive, but triple net property, the tenant owns the equipment. Landlord, you don't own that equipment. And they go through it every 3 or 4 years. I saw his cash flow though. His car washes were doing like $3 to $3.5 million. You want to know what his costs are? Soap and water. So like the pure profit that those operators are making on them is insane. Now, to my point earlier, at the end of that lease, if he's doing $700,000 a year, who are you going to get to replace that lease with, that rent with? If he doesn't stay, there's no way you're gonna replace that rent.
Well, also, and I don't know that market, but 700,000 seems incredibly high.
Yeah.
For that, so
Yeah.
if that guy's doing well, he could be like, "Well, I'll just go buy and develop my own."
Well, he was developing it. And he's like, and now he's like, I've got these 6, 7. He's got like 50 of them now, but this was like 4 years ago. He's like, I've got these 6, 7 pieces of real estate. I'm looking at cap rates. I'm looking at the rents that I could set. I can get a 3 or 4 rent coverage ratio, meaning he could pay his rent with his profit 3 or 4 times. He's making that much money. At like $600,000-$700,000 a year in rent. So it made sense for him to do it. It's a safe enough play for as a landlord of like, yeah, he's gonna be profitable there. But from a pure real estate perspective play of like, what's the market rent? Is this market rent replaceable if this tenant ever left? On a per square foot basis, it was something like $150 a foot. For in triple nets, that's probably 5 or 6 times the market rate.
But my point though is, at some point, is there a little price gouginess to that? But I guess it's the market. There's always gonna be somebody to pay, and if nobody pays, then he's got to lower the rent.
Yeah.
That's the beautiful thing about being in business purpose transactions. There's no such thing as price gouging.
Yeah.
That's why I don't loan to people. I only loan to companies.
It's all negotiable. I mean, the buyer is going to do their diligence, and they should. If you're not buying from a corporation, that's another warning for triple net leases. Just because it says corporate lease doesn't mean it's corporate lease. If it's a franchise on that lease, get your hands on those financials. Understand how they're doing. That's where you need some sophistication. A good broker will lead you astray from those kind of pitfalls. Some people, this happened with Carl's Jr. Carl Karcher, founder of Carl's Jr. His grandkids inherited a franchise. They weren't doing so good around 2006, 2007, so they decided to sell the real estate. They sold a bunch of the real estate for probably twice what the rents should have been set at, but they needed the cash. So, high rent, price is dictated off of a percentage of the rent. So the higher the rent, the higher the price. So they sold probably 10, 15 pieces of real estate for crazy high prices. 2 years later, declared bankruptcy. Can't pay the rents. As a landlord, your lease is now worthless. Class action lawsuit, they ended up getting theirs in the end, but that's just a cautionary tale of just because you have a 10, 15-year lease, if you're with a 2-unit car wash operator paying $500,000 a year in rent, you better make sure he's good for that $500,000 a year in rent, unless you want to go operate a car wash.
It sounds like you should.
Based on the numbers on them, I would love to be operating car washes.
Yeah. Well, owning and operating, not just operating.
Yeah, I don't want to be sitting. I don't think.
Especially in Texas.
I don't think you'd be
kind of hot.
I don't think you'd be a good towel boy.
Hey, you don't know.
Stop.
Okay.
All right. So what are you seeing in the market the rest of this year?
It was survive till 25, and now it's survive 25.
Wow, I haven't heard that. That's actually pretty good. I haven't heard that.
Yeah.
I completely agree with him.
Yeah.
I mean, I hate to tell you, but I think my crystal ball is broken. I'm selling that last property up in New York. We re-tenanted it, maximized our value, and I'm looking at comps, and it's all stuff that's been sitting on the market for 200 days. So when I'm pricing it to beat those cap rates by about 50 to 75 basis points because I want this thing to sell. Now, I might be leaving some money on the table, but like there's just not enough comps to give me good pricing. I don't know what this is going to trade for. My crystal ball doesn't really work as good these days.
I feel like the winter wasn't as dark as I thought it would be. I think, when rates dipped in September, it created some momentum into fourth quarter that carried us through.
Mm-hmm.
There's consumer optimism in the real estate investor sector. I'm honestly not that sure where it comes from. I mean, I think transaction volume is going to be way down. Interest rates are going to stay high or even go higher. And
I think the optimism's coming from we had such a shock in 22. The way the rates went that year, it got so bad, and then you had that trickle over from there was still the transactions of need that arose in the early part of 22 that kind of we really felt it towards the end of 22 and early 23 that we've come through that darkness, and now we're kind of like, okay, we're consistent, at least we're the rates are within 100 basis points, but it's staying around the same levels right now. We're not going to get another 4,000% increase.
Yeah. Well, I think that the best point there is in all of 22 and 23, I was like, we have to get away from this recency bias and remember that really a 6% rate on a home mortgage isn't that high. And I think, to your point, now that we've been through 23 and been through 24 and we're into 25, I think
we're back to where normal should be.
The sticker shock.
Prices just need to reflect that.
Right.
Yeah.
That's what they said. That's what they talked about this morning. Like the 2021 rates, that's the anomaly.
Yeah.
Like this is the normal, not the new normal, because this is like it was 20, 30 years ago.
I'd like to see the 10-year get back below 4, because that was where when I came into the industry in the early teens, that was kind of where it hovered around, and that was a great time for transactions. It wasn't. You were able to make deals make sense at prices that made sense, I thought, and based on reasonable. Beyond looking at just cap rates, looking at real estate fundamentals, looking at market rent, looking at price per square foot, deals made sense. And we just got to get away from that recency bias of 2021.
That's right. All right, man. Well, I appreciate you coming in. It's been a pleasure, and let us know what you find out there.
I'll tell you if I see it.
I feel like this is the ender of it was like on the down track. It's like, depression.
Well, it's not. I mean,
where's the uplift, Tim?
I feel like the uplift is an understanding that maybe the worst is over, in that we're not going up 4,000%, and instead we're going to be stable. And I think it takes the consumer a little bit to catch up, but then it's back to business as usual, just with a different price tag attached to it.
Yeah.
Okay.
Yeah.
Got it.
It was positive to me. I just got a little melancholy, I guess, because I like low rates because as a lender I make more money.
Well, I like money too.
Appreciate you guys stopping by. We'll see you next week.